What if I told you that the biggest financial reset in modern history is not a theory anymore, but a process that has already started? What if the sharp moves you are seeing in gold and silver are not random, but signals? Signals that liquidity is tightening, that trust in the system is weakening, and that smart money is positioning quietly before the next phase begins. Welcome to Gold Silver's Scope, where we break down what is really happening in the gold and silver market in simple and clear terms. Right now, we are witnessing something very unusual. Gold and silver are not just moving, they are swinging aggressively. We are talking about $100 daily moves in gold. That kind of volatility does not happen in calm markets. When you see big vertical moves up and then sharp drops down, that tells you one thing: instability. And instability is fuel for precious metals over the long term. But here is something most people misunderstand. If you are buying gold and silver for protection, you should not be obsessed with daily price action. Short-term volatility is noise. The real story is long-term currency debasement and structural financial weakness. Let's talk about what is happening behind the scenes. Dealers across the country have been experiencing massive transaction volume. In some cases, wholesalers are backed up for weeks because so much metal is flowing into the market. Interestingly, it is not that gold and silver are impossible to get. It is that liquidity, actual cash, is tightening. When too many people try to sell at once, dealers must manage how much inventory they can absorb. They only have so much working capital. This is why, in some cases, spreads widen dramatically. A wide spread between buy and sell prices tells you something important. It tells you dealers are protecting their liquidity. In silver especially, there have been moments where certain forms of silver are not being aggressively bought back. That is not because silver has no value. It is because cash flow management becomes critical when volatility increases. Liquidity drying up in pockets of the physical market is a warning sign. It does not mean collapse, it means stress. We are also seeing large online retailers increasing minimum purchase requirements. Why would they do that? Because transaction volume becomes overwhelming during panic phases. When markets move fast, emotions move faster. Retail investors rush in, some to buy, some to sell. Managing thousands of small transactions creates operational strain, so minimums go up to slow the flow. Now here is the key point. None of this changes the long-term thesis for owning gold and silver. Gold and silver are not trading tools first. They are monetary insurance first. If you own gold for protection, you are not supposed to trade every swing. You are supposed to accumulate strategically and hold. Think like a central bank, not like a day trader. Central banks do not buy gold because they expect a $100 move tomorrow. They buy gold because they understand currency cycles. And this brings us to the bigger picture. Why are central banks around the world buying gold at record levels? Why are emerging economic blocs pushing for alternatives to dollar dominance? Why are governments printing unprecedented amounts of currency year after year? Because the global financial system is overloaded with debt. Since 2008, governments responded to crisis with one main tool: money creation. When the financial crisis hit, trillions were injected into the system. At that time, many people expected immediate runaway inflation. Instead, we got asset inflation. Stocks, real estate, bonds, all pushed higher by cheap money. But the printing never stopped. Then came more stimulus, then more debt expansion, then more balance sheet growth. Each crisis has been solved with more currency creation. That works until it doesn't. Inflation is not an accident. It is a policy outcome. When you expand the money supply faster than productivity grows, purchasing power declines, slowly at first, then suddenly. Many analysts now openly discuss the idea of a monetary reset. This is no longer a fringe topic. The concept is simple. When debt becomes too large to service honestly, systems restructure. That restructuring can take different forms: currency devaluation, debt jubilees, capital controls, or even overnight revaluations. A hyperinflationary reset does not mean prices just go up. It means confidence breaks. And when confidence breaks, people rush toward hard assets. Gold has survived every currency system in history. Paper systems come and go. Gold remains. Now, does that mean hyperinflation happens tomorrow? No. These events build gradually. But we are clearly in an acceleration phase. Government deficits are expanding. Interest payments on debt are rising. Commercial real estate is under pressure. Consumer savings rates are weakening. These are not isolated problems. They are interconnected. Here is something else important. There is a looming issue in commercial real estate. Many properties were financed during ultra-low interest rate periods, loans at 3% or 4%. Now rates are much higher. Property values have declined in many areas. When those loans need refinancing, some owners may struggle. If defaults increase, financial stress spreads. What do central banks usually do in those situations? They lower rates. They inject liquidity. They print. And what happens when you print more into an already inflationary environment? You weaken purchasing power further. That is why gold and silver are not reacting randomly. They are reacting to structural fragility. The volatility you see today is not the end of the story. It is the beginning of a bigger repricing cycle. In Part 1, we talked about volatility, liquidity stress, and why daily price swings should not distract long-term gold and silver holders. Now let's go deeper into the bigger and more serious question. What does a hyperinflationary reset actually mean? And why are more serious investors starting to prepare for it? First, let's simplify the concept. A hyperinflationary reset does not start with people carrying cash in wheelbarrows. It starts with excessive debt. When a country builds up so much debt that it cannot realistically repay it through taxation or economic growth, it faces only a few choices. It can default openly. It can restructure the debt. Or it can devalue the currency. Most governments choose currency devaluation because it is politically easier. Instead of telling citizens directly that the system failed, they slowly reduce the purchasing power of the currency. The numbers in your bank account stay the same, but what those numbers can buy becomes less and less. Now think about the last 15 years. After the 2008 financial crisis, central banks around the world printed trillions. Interest rates were pushed near zero. Balance sheets expanded massively. That was supposed to be temporary. But every time the economy slowed, more liquidity was added. Then came more stimulus. Then emergency programs. Then more debt issuance. The global system never deleveraged. It re-leveraged. Government debt today is dramatically higher than it was before 2008. And servicing that debt is becoming more expensive because interest rates are higher. When interest payments start consuming larger portions of government budgets, something has to give. This is where the idea of a reset becomes relevant. A reset can take different forms. It could mean cutting zeros off the currency. It could mean revaluing gold on central bank balance sheets. It could mean introducing a new monetary framework. It could mean digital currency systems combined with tighter financial controls. We do not know the exact form, but history tells us one thing clearly. No debt-based fiat system lasts forever. Look at examples from the past: Weimar Germany, Zimbabwe, Argentina. These are extreme cases, but they show a pattern. Excessive money printing leads to loss of confidence. Loss of confidence leads to currency collapse. And during those periods, hard assets outperform dramatically. Now some people say, but this is the United States. That cannot happen here. That argument assumes that economic laws change based on geography. They do not. Mathematics does not care about borders. What makes the current environment more complex is that we are not just dealing with domestic debt problems. We are also seeing global shifts in power. Emerging economic alliances are challenging dollar dominance. Central banks outside the West are increasing their gold reserves at record levels. Why? Because gold is neutral. It carries no counterparty risk. It is not someone else's liability. When countries diversify away from dollar reserves and into gold, that is a signal. Central banks are preparing for a world where trust in paper reserves is weaker. Let's talk about fundamental valuation for a moment. Some analysts calculate gold's fair value by comparing it to the size of the monetary base and total debt levels. When you measure how much currency has been created versus how much gold exists, the implied valuation can be dramatically higher than today's market price. That is where projections of 5-digit gold prices come from. The logic is not emotional, it is mathematical. If currencies continue expanding while gold supply grows slowly, the price must adjust higher over time. Silver is even more interesting in some ways. Silver has both monetary and industrial demand. It is used in electronics, solar panels, electric vehicles, medical applications, and more. At the same time, above-ground investment silver is relatively limited compared to gold. That creates the potential for sharper moves during monetary stress periods. But remember something important. Markets never move in straight lines. Even in powerful bull markets, there are deep pullbacks. There are scary drops. There are moments when people think the thesis is broken. That is normal. Volatility is part of repricing cycles. Right now, many investors are asking, is it too late to buy gold and silver? That question usually appears after strong price increases. But the real question should be different. Instead of asking whether the price is high compared to last year, ask whether currency risk is lower than last year. Has government debt decreased? No. Has money printing stopped permanently? No. Has inflation risk disappeared? No. Has geopolitical tension declined globally? No. So if the fundamental drivers remain in place, then temporary price levels become less important. Another important factor is psychology. When gold rises quickly, it attracts attention. Conferences get crowded. Retail demand increases. Media coverage expands. But excitement phases are often followed by consolidation. That does not mean the cycle is over. It means markets are digesting gains. Long-term wealth preservation requires emotional discipline. If you buy gold expecting instant profits, you may be disappointed. But if you buy gold understanding that it is insurance against systemic risk, then daily volatility becomes easier to ignore. Let's also address interest rates. There is strong pressure in parts of the economy, especially commercial real estate, where higher rates are creating refinancing risk. Many properties were financed during ultra-low rate periods. If those loans reset at much higher rates, cash flow problems can appear. If defaults increase, financial institutions feel pressure. Historically, when systemic stress rises, central banks respond by easing monetary policy. Lower rates typically support gold because they reduce the opportunity cost of holding a non-yielding asset. But even more importantly, rate cuts often signal economic weakness. And gold thrives in environments where confidence in financial assets weakens. So when you combine excessive debt, refinancing risk, global currency competition, record central bank gold buying, and persistent inflation pressures, you begin to see why the long-term case for gold and silver remains strong. The real question is not whether volatility will continue. It will. The real question is whether the underlying system is becoming more stable or more fragile. From a structural perspective, fragility is increasing. Now let's bring everything together and talk about strategy. Because understanding the problem is only half the battle. The real question is simple. What should you actually do? If we step back and look at the big picture, we see rising global debt, long-term currency debasement, record central bank gold buying, structural pressure in commercial real estate, and governments that historically respond to stress by printing more money. Whether the reset comes slowly through persistent inflation or suddenly through a monetary restructuring, the direction of purchasing power over time has been very clear. It declines. So the goal is not to predict the exact day of a reset. The goal is preparation. The first mindset shift you must make is this. Gold and silver are not investments in the traditional sense. They are monetary insurance. When you buy stocks, you are hoping for growth. When you buy real estate, you are hoping for appreciation and income. When you buy gold and silver, you are protecting purchasing power. Think like a central bank. Central banks do not buy gold because it pays interest. They buy it because it is a reserve asset with no counterparty risk. It does not depend on a company's earnings. It does not depend on a government's promise. It simply exists as value. When you hold physical gold and silver, you remove part of your wealth from the financial system. That does not mean you exit the system completely. It means you diversify outside of it. Now let's talk about allocation in simple terms. Every person's situation is different. Age, income, debt level, and risk tolerance all matter. But the principle is diversification. Many conservative wealth protection strategies suggest holding a meaningful percentage of net worth in physical precious metals. Not 100%, not zero. A balanced portion that acts as insurance. If you own no gold or silver, you are fully exposed to currency risk. If you own some, you reduce that exposure. The next question people ask is, physical or paper? There are gold ETFs, mining stocks, futures contracts, and digital representations. These may move with the price of gold, but they are still inside the financial system. They carry counterparty risk. In a true systemic event, access to those assets could become complicated. Physical gold and silver in your direct possession or secure storage removes that layer of risk. That is why serious wealth preservation strategies focus first on physical ownership. Silver deserves special attention. It is more volatile than gold. It tends to move harder in both directions. But in strong precious metal bull markets, silver often outperforms gold on a percentage basis. At the same time, because silver has industrial demand, supply shortages can amplify price movements. However, volatility means patience is required. If you cannot emotionally handle 20% swings, you must size your allocation accordingly. Discipline is key. Another important strategy is dollar cost averaging. Instead of trying to time the exact bottom, you accumulate gradually over time. This reduces emotional pressure and smooths entry price risk. No one consistently buys the exact low. Even professionals do not. Now let's address the too late question one more time. When gold moves up sharply, fear of missing out appears. When gold pulls back sharply, fear of loss appears. Both emotions are dangerous. The long-term thesis is based on currency expansion and debt levels, not on yesterday's candle chart. If governments continue expanding debt faster than economic growth, currency purchasing power will continue eroding. That is the core driver. And that driver has not changed. We are living in a period of monetary transition. It may take years to fully unfold. There may be policy experiments, digital currency rollouts, rate cuts, stimulus waves, and geopolitical shifts. But through every historical transition, one asset has consistently bridged monetary systems: gold. Silver follows that monetary wave, often with greater intensity. The most empowering idea mentioned earlier is this: owning gold and silver makes you your own central bank. In a world where most financial decisions are outside your control, interest rates, tax policy, monetary expansion, holding real money gives you a degree of independence. It does not solve every problem, but it gives you leverage against uncertainty. Now here is your action step. If you found this breakdown valuable and you want clear, no-hype analysis on gold and silver markets, make sure you subscribe to Gold Silver Scope. This channel is dedicated to helping you understand what is really happening behind the headlines in simple English, without noise and without distractions. Share this with someone who needs to hear it, especially those who keep asking, is it too late? Because preparation is not about timing panic, it is about understanding cycles. And finally, a short but important disclaimer. This content is for educational purposes only. It is not financial advice. Every investor should do their own research and consider their personal financial situation before making any investment decisions. The volatility we are seeing today is not random. It is a reflection of deeper structural shifts. Stay informed, stay disciplined, and most importantly, think long-term. I will see you in the next analysis.